Now, Kenyan investors holding on to government paper have been advised to keep holding on to those investments or buy even more in order to maximize their returns. This is according to Standard Chartered Bank Head of Affluent Banking, Paul Njoki, who notes that the current rate remains very attractive to investors, with the window fast closing as the central banks across the world mull the reduction of interest rates. Jimmy Mbogo has more on the bank's outlook for the second half of the year.
The first half of 2024 was characterized by high inflation rates that saw central banks across the globe tighten their monetary policy. The high interest making government bonds attractive. However, as central banks prepare for monetary easing, bond investors are being urged to hold on for maximum returns. According to Standard Chartered Bank, in the second half of the year, investors should be looking at the equities market, the bond market and gold market, with those holding cash being urged to start releasing it as the horizon that could have seen them earn more is coming to an end.
Allocate a part of your investment into global equities, a portion of that, right? And if you want to go sub-segment of global equity, I'll say US, okay? Okay, so that's number one. The second thing I'll say, have a proportion of your investment that is in the bond market. Now, that you can slice to local bonds, or you can say, US dollar bonds as well. And if you still want to go a slightly, dimension, you can say emerging market, US dollar bonds.
It has also emerged that Kenyan investors are shying away from real estate investment as its growth from both a returns and yield perspective begin to deteriorate, with yields slowing down to range between 3 and 5%, with the middle tier giving a return of 9 to 10%, forcing investors to other asset classes such as money market funds, which have taken advantage of the bond market to offer better returns to investors.
While traditionally real estate has provided a fantastic opportunity for Kenyans to invest, I think time has come that we need to look at that asset category in the light of what other alternatives are there, and pound for pound check whether actually we are making a return. But the money market funds are doing very well. Of course, the underlying asset or securities in a money market funds are bonds and bank deposits. So then you can actually translate and see if the bonds are giving a good rate, T-bills are giving a good rate, you go to a bank deposit, you get a good rate. Then it goes without saying that that gain is being in a money market is transferring as well to the investor.
However, political transitions across the globe have been highlighted as an area that could present a significant risk for investors in the second half of the year. With central banks globally expected to cut rates in the second half of the year, investors are being urged to ensure that they look at bonds, equities and gold as viable investments. Jimmy Mbogo, Citizen TV, Nairobi.